Hello and welcome back to the Dukascopy Studios here in Geneva. I'm joined today by Eric Vanraes, Head of Fixed Income at E.I Sturdza. So Eric, welcome back to the studios.
Thank you.
So yesterday we saw the Fed announce that they were going to keep interest rates on hold. So were you expecting this?
I was expecting this, but honestly, I was also wishing for a very small rate hike, because in my opinion, it's not good news finally. And this morning I was thinking to myself, maybe it's the first time in my life, I've been managing bond funds since 1990, and normally central bank rate hikes are the enemy of bond fund managers. And I was thinking to myself this morning, it's the first time in my life that I'm wishing for a rate hike, because many questions now must be asked, because normally the US economy is strong enough to allow a first rate hike. Normally, because we can discuss and analyze the figures, but unemployment rate is at 5%. Inflation is just below 2%. Core inflation is just below 2 because CPI is just above 0. And growth is above 3%. So it should allow a first rate hike. Obviously, international developments in emerging markets, and first and foremost in China, led the Fed to postpone the first rate hike. But it's a problem, because for me, money must have a value, even cheap. And when you say that the value of money is zero, money is free, it's not normal. So a first rate hike would have been a good solution, because honestly, between 0 and 0.25, the difference is small and the impact is small. But it would have been a signal to say money will still be cheap, extremely cheap, but free money is not normal, and we stop giving free money to the markets.
Absolutely. And announcements have been made by some that the bond markets are now in a relief rally. So how have bond markets reacted, in your opinion, since the decision last night?
Bond markets, it's really, you are right to say bond markets, because there are so many different markets. Government bonds, corporate spreads, high yield, and the behavior of these markets will be totally different. First and foremost, on the US Treasury curve, we experienced a bullish steepening behavior of this curve. It's normal, because if the central banks say that they don't raise the rates and they have an ultra dovish statement, the 2-year yield decreased dramatically from 0.80 to 0.67, so a 13 basis point tightening. On the other side of the curve, the 30-year Treasury didn't move so much, from 3.07 to just below 3, so 8 basis point tightening. So the curve is steeper. That's the short-term view. On the long term, I'm still a fan of the flattening of the curve, and I'm still a fan of 30-year Treasuries. Because when a central bank says that they don't have enough information in order to start to normalize the monetary policy, and at the same time the ECB wants to increase its QE, and you know what happens in China, everywhere around the world, you must be worried about the global economy and global growth all over the world. And when you are scared about the evolution of growth, the sweet spot is 30-year Treasuries. And in other markets, on the short term, it's really good for corporate bond spreads. So corporate bond spreads and equity markets will probably move and go up. But on the long term, I'm not sure it's good news for risky assets, equities and bond spread, and high yield first and foremost.
Absolutely. So are there any consequences on the long-term markets? You mentioned equities could be at risk. Do you see anything else being at risk?
The risk in the equity market is that they don't understand the message of the Fed, and they continue to perform. Because the cocktail of the Fed today, I'm afraid they are wrong. It's cheap money and raising markets provoke a self-sustaining recovery. And I'm afraid it's not possible, it's not true. So equity markets, I pray that they won't rally dramatically, because it would be a false message, an error. And the best news that could happen this afternoon would be a modest performance of the S&P. Tonight, the Tokyo closed at -2%, so maybe equity markets will not rally dramatically, and it would be good news, because it was the solution after the crisis, but now it's time to give the message that free money is not the solution and ultra cheap money is not the solution. But nobody knows, because the big question is, what is the price of risk in a zero interest rate universe?
Absolutely. Well, Eric, thank you so much for coming in today and sharing your expertise with us.
Thank you very much.
And thank you for watching. For all the latest Ducoscopy updates and interviews, do keep clicking back. Goodbye for now.